We're going to continue our discussion of inventory by talking about the specific identification, LIFO, FIFO, and weighted average, but we're going to be doing it under the perpetual method. There's another method called the periodic method, and that's something that's talked about in the appendix to this chapter, and we'll address that briefly after I get through talking about all of these methods using the perpetual system. The way that we track inventory in our books doesn't necessarily need to follow the physical flow of costs. In other words, we're not going in and making sure that, we put a little, green circle or something on the label of the stuff we bought this time so that we can actually make sure that it's what we're selling from the most recent batch rather than the last batch. We don't care so much with regard to the physical flow, except when it comes to maybe perishable items, which we obviously want to sell the older stuff first before it goes bad. But the way that we track it doesn't have to follow the way that it moves in our door and into the customer's hands. The balance sheet will contain the ending inventory for our inventory cost, and the income statement will contain the cost of the goods that we've sold. Our example here is going to be the mountain bike inventory of trekking for the month of August using the perpetual system. This is a system that has us computing the inventory in real time as it comes in and out of our warehouse. So as we're buying it, we're updating our inventory. As we're selling it, we're updating our inventory. And you'll see how that contrasts later with the periodic method. But in this case, we've got our purchases that come in and then, beginning inventory and then purchases. Then we've sold some items, and then we've got more purchases, more sales, and then the total. And so the units available is what we could have theoretically had to sell over the course of the month. And the total of these costs are our goods available for sale. Now, we sold some goods, and we're not going to worry too much about ending inventory at the moment because that's where all of these LIFO, FIFO methods come in. But we'll talk about in terms of number of units versus cost of what we sold. So we sold 43 units. We had a total of 55 units to sell. And so that must mean that we have 12 units left in our ending inventory. Now, this specific identification method, we're going to do that first. And what I said about the physical flow of goods doesn't really apply to the specific identification method because, in fact, we are going to track the items through our inventory very specifically. So if we're a car dealer, we're going to know how much we paid for that particular car that we've sold. We're not worried about the average price of the Toyota Corollas and assigning a weighted average or the last batch of Corollas that arrived on our lot. We're going to track this car because it's probably going to have some unique features to it. It may or may not have leather seats. It might have floor mats or a roof rack or whatever. So they're going to be unique enough that we're going to track each specific item. If it were jewelry, for example, and we were a jewelry store, we might similarly have specific identification used because not every pair of earrings is going to be identical. So in this case, we've got goods available for sale on October 1st of $910, and we sold them all. So we have no ending inventory. Same thing happened on August 3rd, and we sold everything. August 17th, we had 20 items, but we only sold 15 of them. Now, we know what we paid for those 15 items, so that becomes really clear that our cost of goods sold are 15 of these that we paid $115 for. And we then know that the 5 we have left are also at that same $115 to give us our total ending inventory of $575. We then, on August 28th, sell 3 of the 10 items we bought at $119, and that adds up to a total cost of goods sold for the same 43 items we talked about on the last slide of $4,582, and the same 12 items in our ending inventory. We have 5 at $115 and 7 at $119 to give us an ending inventory of $1,408. Now we'll talk about first in, first out, or FIFO. The oldest costs, in other words, we're going to start selling from the stuff we had first. If we had beginning inventory, we're going to assume that the stuff that was sold first came out of our beginning inventory, and then from the first batch we purchased, and then the second, and then the third, and on down. It's again unlikely that we've completely sell out of absolutely everything that we have. So what's left in our inventory is going to be considered the stuff that we bought most recently, because the other stuff was sold first. So let's take a look at our example of the, I can't even remember what it was we were selling here, but whatever it is, it's the same items. We had a beginning balance. We bought some stuff on August 3rd. So we had $910 sitting in our beginning inventory, which was our ending inventory under a FIFO method last month. And then if we add to that the 15 items we bought on August 3rd, my birthday, by the way, it's $2,500 total inventory balance. Now, August 14th, we go and sell some stuff. How many items did we sell? We sold 20. Well, we had 25 items to sell. We had the 10 in the beginning inventory, the 15 we bought. So we had 25 that were available for sale, but we only sold 20. Because we're operating under the FIFO method, we're going to assume that we sold first out of that beginning inventory and wiped out the 10 that were in the beginning inventory. We then moved to the purchases on August 3rd for the other 10 that we sold, and that gives us a cost of goods sold of $1,970. We have 5 left on hand, and we will assume, again, because we believe we determine that we've sold everything in the beginning inventory, what's left is from the August 3rd purchase, leaving us with an ending inventory of $530. We buy some more stuff on the 17th, we buy some more stuff on the 28th, all at different prices. And so by the time we get to the 28th, we actually have 3 different layers of costs sitting in our inventory. We go to the sale on the 30th and we sell 23 items. We assume that 5 of those came from the earliest batch, and then 18 came from the next batch. And what that left us with is 2 at the, I guess it was August 17th purchase that were left, and the rest were from the purchase on August 28th. And so that gets us a cost of goods sold for this August 30th sale of $2,600. If we add that to the earlier sale in the month, we have cost of goods sold of $4,570, and we have ending inventory of $1,420. Now we will talk about last in, first out, or LIFO, which is exactly the opposite of FIFO. We're going to assume that the stuff that we just sold came out of the stuff that we just purchased, and that the stuff that's in our ending inventory is the stuff that was probably in our beginning inventory. So same example here. We've got the same purchases coming in, but now when we go to make that first sale on August 14th, instead of taking first from the beginning inventory, nope, we're going to take first from the stuff we just bought. And of the 20 items we sold, we're going to take 15 of them out of the August 3rd purchase and then the remaining 5 out of what was in the beginning inventory. And we'll end up with an inventory balance after those 2 sales. We've got 5 items left from that beginning inventory of $455. Our cost of goods sold is $2,045. We have 2 more purchases that we undertake, and we're here on August 28th. We've got 3 layers of items in our inventory, but the composition of those has now changed from the last example because we started selling from the beginning items, or excuse me, the ending items first in this example. So now we get to the August 30th sale. We've sold the same 23 items that we sold on the last 2 examples, but we're going to take the first of those items from the August 28th most recent purchase, and then the remaining items are going to go back to the August 17th purchase. And look at this, we still have items from our beginning inventory. Now that we're at the end of the month, we're still carrying on our balance sheet the 5 items that we started the month with, and then the remaining items are the items that we purchased on August 17th. Now we get to weighted average, and what we do in terms of weighted average is that we take an average of the cost of goods sold times the number that we purchased at that amount. So we've got cost of goods available for sale, and we're going to do this at each sale, and then we divide that by the number of units that we had available to sell at each sale. So this gets a little bit more complicated because we've got our beginning balance, and if all we did was sell out of that, then we would have no other cost to average in, but we actually bought some items before we made our August 14th sale, so now we need to take a weighted average. We don't want to just take the average of 91 and 106 because we only had 10 items at the 91 and 15 items at the 106. So if we just took an average of the 2 unit prices, that would not get us a weighted average. That would just get us an average price. So we want to weight that based on the number of items in our inventory at each of those respective costs. So we have a total of 25 items in our inventory, and the average of that comes out to $100 per item. So we had 25 units available for sale, and that gets us to the $100. So now when we go to do our sale on August 14th, we're going to assume it's $100, and we're not going to worry about layers at that point because now everything has been melded together into 1 unit cost. Oops. Now things get a little tricky. So now we're purchasing items on the 17th of August. We need to recalculate the weighted average. We know we have 5 units left that we didn't sell after the August 14th sale. Those were at $100 a piece. We've now bought 20 more at $115 a piece. So we've got $112 average unit for the 25 units. Come on, there we go. So we had, there was a total of $2,800 of cost between these 2 items, and divided by the 25 units that we have, that gets us the 112. And I won't talk you through the calculations. I'm sure you can read those. All right, now we bought some more items. So now we have to recalculate our inventory. And we use the same thing. You can rewind the video if you want to, I guess, see how I calculated that. But basically, we've got 10 more items now. And now we need to take the 25 at 112 and average in the 10 at 119. We've got a total inventory cost of $3,990, 35 units gets us $114 per item. Well, so here we are on August 30th, and we've now sold some items. This is easy peasy because we've already calculated the weighted average of these items. So now when we go to sell these 23 items, it's just at that single weighted average price. And that means that what's left in our inventory also at that single weighted average price. And these are, again, just all of the individual calculations. So I'm gonna actually stop this video here and we'll go on to the next learning objective.